Good morning, this is Clark Cat Ong with the Keller Williams VIP CK team, and here we are again at another podcast. We had her as a guest before, and here she is again, Ludi Magada. So on the last time, we interviewed Ludi regarding taxes. That was our topic, but this is probably a more important detail because without doing this, you cannot file proper taxes. And she does have a business on bookkeeping. So thank you so much, Ate Ludi, for coming into our podcast today.
Hello. Thank you again for having me. It's my pleasure, and hopefully I can give insight to your viewers, which is going to be my viewers as well. So thank you for having me back.
Okay, gotcha. Well, Ate Ludi is very humble, but here's my experience with her. So when I had an accountant do my taxes, and I still have them. But the first time I had Ate Ludi do my bookkeeping, that was when I got a pretty good refund on my taxes because without her, a lot of the things that I was spending on for business wasn't being taken into consideration. Even depreciation of rental properties wasn't taken into consideration. So we're not using the tax code as it was provided by the government. So when Ate Ludi, the bookkeeper, came by and did my bookkeeping, this was when all the expenses were streamlined in a way, and I could say I'm pretty happy. So I'm very thankful that Ate Ludi continues to be my bookkeeper, and every time someone asks me for a tax strategist or a bookkeeper or a resource person for taxes, I always refer Ate Ludi. And same thing with me. If I have a question regarding taxes I'm not so sure about, I just text her and she gets back on me the same day. So I'm very thankful for that. You cannot see that on other accountants. What is the importance of bookkeeping or record keeping? Or rather, what is bookkeeping, Ate Ludi?
So bookkeeping is really important because this is how you organize your records before you file your tax return. And there's a lot of people that's not utilizing this process because they don't know any better. You know, they don't get it from other people. They don't get any consultations or anything like that. So bookkeeping, this is when you gather all your documents, you put it in a report and make that ready until it's time to file your tax return. Why is it very important? It's very important because, for instance, you have multiple businesses, and one of them is, say, rental property, and then you have group home, and there's other businesses that you have to keep your records on. So it's very important to separate all those records in a financial statements, because there's an instance where this is actually it's a real example where the business owners did file their income twice. So that means that they paid twice on that income to the IRS. So it's very important that you do have a separate record on each businesses that you have. Now, is it costly? It will cost you something, but it will actually save you money in the long run, because once you redo your taxes, it's going to cost you more than doing it right at the get-go.
Okay. So a lot of it, if it's not done right, then it's going to cost you a lot more. That's what it says.
That is correct. And another reason why we do bookkeeping is for tax compliance, because we know, and I did mention this on the previous podcast that we had, that audit doesn't happen just because you make a mistake or the accountant make a mistake, the tax preparer made a mistake. It's because sometimes they do a random audit. And once you get audited, you have only some time period to submit all the documents that the IRS will ask. And most likely, if you're in a business, they will ask for your financial statements. And if you only have, say, 10 days or say 30 days to comply, you have 12 months of bookkeeping you have to prepare before you can even submit that document. So if you get audited, for any reason, you already have that ready to send to the IRS, and make sure that financial statement does match exactly to what you filed on your tax return.
Okay.
So that's a tax compliance, and it's very, very important.
So you mentioned audit. Is there a difference? Are you more likely to be audited if you're a W-2 versus you're a 1099 versus if you're an LLC?
No. Now the IRS, they look at the income, if it's a high income, or if you're not constant, like for example, your income this year is 100,000 and then you went negative the following year. So the flow of your income, they look at it like, why is it changing so much? So that could trigger an audit. Or sometimes they just, for W-2 people, they just randomly pick numbers, your last four social security, and your name get picked.
Oh, okay.
Yeah.
Importance of bookkeeping would be, if not done right, then you'll pay a lot more money. If done correctly, then you save money in the long run. And even if you get audited, you have all the records to show. If you do get audited, because audit could go up to how long? Like 5 years?
10.
10 years.
Yeah, 7 to 10.
So let's go to the common bookkeeping mistakes.
Yes. So again, like I said, if we don't get advice from professionals, we do make mistakes, right? And for instance, the personal expenses versus having a business expense. If you're a business owner, the IRS will tell you to not mix your personal and your business finances. And I always tell that to my client, if you do have business, please keep it separate, because number one rule of the IRS is no commingling, meaning you don't mix your personal to your business. Because again, when it comes to audit, it will be harder for you to separate and to tell the IRS which one is really for business and which one is for personal.
Okay, so it's best to have a separate credit
bank
card
account.
for a
Yes.
bank account
So
for
what
the business.
I usually advise my client is, if before you even start your business, because once you get your EIN, your federal ID number, and your business name, that's the only thing you need in order to apply for your bank account. Open your bank account right away, because usually in my experience, my clients usually use their personal money to invest for their business, which is okay. That's okay. But to continue doing that is a little bit risky, because again, we're gonna go to the tax return the following year and say, oh, I put 100,000 from my personal bank account. That we can actually prove. But going forward, if you keep putting 100,000 out of your pocket and not depositing anything on your business account, that will trigger a red flag to the IRS.
Okay,
Yes.
gotcha. So commingling is one.
Yes.
All right.
And neglecting to track all your expenses is also a one thing that a bookkeeping mistakes. So what I tell my clients is a monthly bank reconciliation or a monthly credit card reconciliation. For instance, if you have a credit card, business credit card, you use that for all your business transactions as well as your bank account. Now, if you don't do a bank reconciliation every month, say you made a mistake and you swipe that card twice, you will not find out that mistake until you actually do a bank rec. Like for example, and if you bought something and again you got duplicated, you will, if you do the audit yourself, even just yourself, not having somebody else's do it,
Right.
you catch the mistake right away. It's the same thing as the doing the taxes. It's better to do it right on the get-go, and you have that awareness right away instead of waiting until the end to find out what that mistake is, because it's going to be harder to prove that How is that duplicated? You just now finding out 6 to 7 months after.
Oh, okay.
So to get the refund back, or to prove that is really a mistake, it's harder for them to prove, and the chances for you getting the money back is probably less than doing it right away.
So also one of the mistakes is, let's say you swipe the credit card on a personal item instead of the business item, then you could note that out, that hey, this was a mistake. This is a personal expense, not a business expense.
Add to your example, if you swipe that credit card, the business credit card, and use it for personal, 5 months or 6 months going forward, you'll forget what you actually bought.
That is true.
Yes.
That is true. Okay.
So now you go to your bookkeeper, your accountant, and the accountant will say, this looks like a personal, even though it really is a business. She's gonna say, because to be on the safe side, it looks like it's a personal expense, so she's gonna code it as a personal. So now you just missed that deduction to become a business deduction instead of,
That's true. That's
yes.
True. Okay. So commingling. Then second is not tracking your expenses at least every month. Okay. And what are the other mistakes?
Inconsistent record keeping, which is it goes along with the bank reconciliation.
Okay.
Because if you're consistent of doing the bank rec, you can really have a better record keeping, better documents, better financials.
Okay.
Yes.
And I'm guilty of that because I get lazy. I get really busy with stuff, but it is very important to do it. I just sent all my bank statements to Ludi.
And that's also another way to do it. I mean, if you just keep all, and it is very important. That's another proof that if you have a business and open a bank account, because if you too busy to do your bank rec every month, at least you have that statements for documentation purposes.
Yeah.
Yes.
Gotcha. Okay. But let's say for someone who it's their first business, it is best to be able to track your expenses and your income, because what is tracked, what is measured gets improved.
Yes.
Yeah.
Yes. And also, as a business, you would want to see how much money coming out and how much money coming in. Correct. Or how much money you're really making. Because if you don't have documentation, you'll find out at the end of the year you actually lost money instead of, which is not a bad thing. If it's your first year in business, usually it's a loss. And the rule is a year to 3 years is a loss. But if you're consistently losing money, then it's not a business. Because the purpose of you being in the business is to have an income, to have a profit. Correct. Yes.
That's true. Again, what is tracked gets improved.
Yeah.
Any other common bookkeeping mistakes?
Yes, and which is the one you just mentioned, ignoring receipts and documentations. So if you go to, say you went to a restaurant and you ate with a client, you weren't sure whether this is a meal for business or a meal for personal. If you're not sure, keep your receipt and send it to your bookkeeper, your accountant, or someone that you ask consultation from, to make sure that you're actually utilizing that expense to a better use.
Okay. Tracking receipts.
Yes, and the final is, which is the bank reconciliation. That's very, very important.
Okay.
Not just bank, but if you have credit card, loans, because if you have a loans, you can reconcile it to find out how much interest you're already paying for the whole year, or how much is going to the principal and stuff like that. Because not all loans is like your regular mortgage that it gives you a tracking on your statement every month. If you do a business loan, it doesn't give you that very, very specific or very detailed statement like a mortgage does.
That's true.
Yes.
That is true. Okay. Now that we're talking about bookkeeping, this all has to do with taxes. So while you're record keeping or your bookkeeping, so when you file taxes, you're able to file taxes properly. So we've touched this the last time, but let's say, what are the common tax deductions someone could have on their business?
So, okay, well, today we're gonna just talk about the real estate investors or landlords as a tax deductions,
Okay.
or some businesses, because it's pretty much kind of like all the same. The only thing is for realtor, or not realtor, but real estate investor or landlords, they can deduct. The most common is the mortgage,
Okay.
the mortgage payment, and that's also with people that owns a home.
Yeah.
You deduct that. And then the depreciation can, and I did mention that from the previous podcast. I did have some sample calculation here. So you can have depreciation for the house that you bought itself, for the improvements,
Yeah.
and for the appliances.
Okay.
Yeah, so those are calculated. Now for the house when you purchase your home, we did talked about the years of how many years you can actually use that depreciation expense, and that's 27.5 years.
27.5.
Yes. For appliances, usually it's 5 years.
Okay.
And for improvement is 15 years. So improvement meaning you rented the house and you wanted to fix the cabinet first, or you want to fix the roof first, or maybe the AC, the HVAC, before you have somebody into the house. So those are included depreciation, not a expense. So there's a difference between an actual expense, like the expense where the entire amount of the improvement is being expensed in one time.
Okay.
So if it's over a 5,000 value, I do recommend that you do a depreciation instead of as an asset, instead of actually expensing it, because that, if it's too much, and that's also a rule for the IRS, if it's 5,000 and up, it's an asset.
Okay.
Right? It's not an actual just expense, straight repair and maintenance kind of thing. Yes.
Okay. 5,000 is kind of low. I mean, it's the prices of material and labor went up so much the past few years. Like 5,000 is probably just like this hallway flooring, maybe. Okay. What are the other common tax deductions that we have?
For landlords is property management.
Okay.
So if you have someone, instead of you doing the managing, you will have a licensed property management to just manage your home. So if the monthly payment that you pay them is obviously a deductions.
Okay, got it.
And then the repairs and maintenance. So I kind of like touch base that just early on, repairs and maintenance versus improvements.
Okay.
So the repairs and maintenance are just minor, like changing your the AC filter.
Okay.
Yes, a little bit, like just a little fix on your toilet. But now, so talking about the toilet, if you fix a toilet, it is a repair.
Okay.
If you replace the toilet and it costs you more than $5,000, it's an asset.
Oh.
It's the same thing as the cabinet. If the door of the cabinet, that's a repair. You're just replacing that, or you're just painting it. But if you're replacing the cabinet, that's an improvement.
Okay.
And it has two different expense code.
Two different expense code. Question: what if you do green? You do something that increases the energy efficiency of the house. So let's say you have to replace the AC, and I understand there's like a rebate on it, and how much you spend if you replace the AC. Does that come into play too, or?
So if it's in the business side, no.
Oh, okay.
Because
it's only on the personal.
Because you're gonna be deducting that entire amount it's gonna be your deductions.
Oh,
yes.
okay.
So for example, you did the AC for $22,000.
Right.
You're gonna depreciate that for 15 years.
Okay.
So you'll be having until that 15,000 is actually fully depreciated. So you're expensing the whole thing. The rebate is for a primary home, it's like an incentive for them to go green.
Got
Because they cannot deduct that as a personal.
Yeah, I know on the for Nevada they deduct like I think $1,200 per unit. So let's say I changed the AC unit to AC units because it was old on my primary home. Then I could deduct the 1,200 times to the 2,400, right? Because it's a primary. But if done on a rental property, then that how much was that? $10,000 is depreciated over 15 years.
Correct.
Okay, that's
yes. So it's either the rebate or you can expense the whole amount you spent for that.
That's a
for that.
depreciation.
Yeah.
How about solar is the same?
Solar is the same.
So if you do it on a rental property, install solar on a rental property, then it would be depreciated over.
Yes. So you can.
Yeah.
So now you have an option. You can put it on your personal tax return to get the rebate. However, you cannot do it on your you cannot expense it on your business because you can only get one.
So
you cannot
only
do both.
one or the
Yes.
other. So if it's a primary home, no problem. Put it on your primary home. Get a 30% rebate. In California, they have
yes.
more. Yeah.
And 30% plus another 25% on the state.
Oh,
if
cool.
you have a state tax.
Yeah, for the state tax.
Yes.
Yeah.
Yes.
But if it's for the rental property, installed solar on the rental property, you purchased it, you couldn't, and you elect to have it depreciated, then you're not getting that 30%.
And that's another one of, actually it's one of the common question asked.
Oh, cool.
Should I put a solar in my rental property? Personally, me being a real estate investor myself, I would say no. Because if you rent your house, the utilities is being paid by your tenant anyway.
Sure.
So now you have the
you
solar
have to put
there.
it on your own name. The utilities on your own name. They wouldn't allow.
Yeah,
Yeah.
correct.
Right.
Yeah. So for example, you put solar. Before they were paying $300 a month for utilities or for electricity per se.
Right.
And then the solar that when you put that, now they're paying what, $15, $13 to connect to the grid.
19.
How are you gonna tell them that this is how much the utilities you need to pay? Because you're paying monthly for that, or you paid it out of your pocket.
Yeah, that's true.
Right. So
Yeah, that's true.
personally, as an investor, I wouldn't put a solar on
a rental
on a
property.
rental unless you're someone that your family live there and you want them to save money for if you have that personal reason. But if in a business perspective, I do not recommend.
Yeah.
Personally, I do not
because if you
recommend.
sell it, then it's a headache too. If you sell it right away.
I had that issue with my other house. Yes, it's hard to sell if they have that solar and it's
it's not
lease.
paid off. Yeah,
they don't want to continue Not all people actually do like to have solar. They're not a believer.
Yeah, because I mean, if you're buying the house, you want to install it so you get the rebate, right? But if the rebate was already taken by the
correct.
seller, then that's kind of
There's no
what we talked about,
no benefits.
Yeah.
for
So what we
you.
talked about on our last video was that what's happening now, since it's a balanced market, the seller has to either pay off the solar or give credit to the buyer to offset the financing cost of the solar and to offset their to buy down their interest. So,
And if you, as a seller, still have a balance in that, now you're paying the balance plus you're giving incentive to the buyer, so you're actually losing money from that solar.
yeah, well, it's either paid off, which would increase the value, or give the money to the buyer. And so, okay, contacts, deductions.
We have more. Yes.
Yeah,
So travel expense. I get these questions a lot because, as we know, we all travel. Business owners travel. Travel expense is deductible. Yes, for if you travel as a business. For example, if you're a real estate investor and there's a seminar going on in Florida, you went there to attend that seminar, so everything is deducted. Your airfare, your meals, everything while you're there.
Yeah.
Yes. Now, if
Everything reasonable, right?
correct.
Yeah, like you couldn't rent out a private jet to go to the.
Or or a yacht
Yeah,
to go
yeah,
fishing.
yeah, or go cruising and then.
It has to make sense.
Yeah, okay,
Correct.
yeah.
Yes, that's a good point. It has to make sense. Because if it doesn't make sense in your accountant eye, it won't make sense on the IRS eyes. I always tell that to my client. If to me it doesn't pass as an expense, IRS will not take it as an expense because they're more stricter than I.
That's why I need a good bookkeeper.
So
Yeah.
now you went there to visit family. It's the expense of the business. And you went to a restaurant, you see there's a beer, like alcoholic drinks, beverages. And you went to a very, very fancy steakhouse with 10 other people because that's your family you're treating.
Yeah.
Yes. So no, those are not deductible.
Okay, got it.
Because it will give IRS a red flag.
Okay.
Yes.
Yeah.
And you have to make sure that your expenses kind of match with your income. Because if you only coming in $5,000 every month and you're spending $15,000, every month, it doesn't make sense.
Yeah, it's a red flag.
Correct.
Okay,
yes.
Got it. And let's say you went with your family. You're the one on the business, but there's like 3 of you. So it's only your expense that's deductible, right? That your family is not?
No.
Yeah, true. Okay.
Yes.
Which is why for me, none of my travel expenses get
I mean, you can separate it to where
it's kind of
just
tough.
take mine. Yeah, just take my expense instead of the whole family.
Okay. Travel expenses.
Another one is a home office deductions.
Okay.
If as a realtor, even a realtor, real estate investor, or a landlord, you don't have an actual office, you can deduct part of your home as an expense every year. It's called home office deduction.
Okay.
Now there is a limit. If you already have a loss in your tax return, they won't allow you to take that home office deduction. You have to have an income. For example, you made 15,000, you expense 10,000, you still have 5,000 profit to report to the IRS. Then you can do. But if you're even like zero, you can't.
Okay.
You have to have an income to offset that.
So how does that work? Like, let's say I'm using the loft as an office. So the utilities minus the square footage.
Correct. So you take the square footage of that loft.
Yeah.
And then you divide it to whatever the entire square footage of the house. You take the percentage.
Yeah.
Now you can take a percentage of your utilities, telephone. You can even do your internet, because of course you're using the internet to cable, anything. So say you're using 5% of the house as an office, then all the utilities 5%.
Okay. Got it. Okay. Home office.
Yep.
All right.
And same thing as utilities, which it's the next
Utilities,
one. Yeah, utilities, if you have a home office. But for a rental home, if you, actually 90% those tenants don't pay the garbage.
Yeah.
Yeah, so the landlord does. So those are deductible utilities.
Okay.
But the electric, if the tenant is paying for it, you can't deduct it as a deductible on your tax return. Only the ones you actually pay.
Okay.
Legal and professional fees.
Oh yeah.
Like your bookkeeper, you pay. Yes, that's also
accountant,
consultant. Yep. If you have
lawyer.
legal consultation lawyers, or you buy forms from other people because you don't know how to do it yourself, there is a company that actually sell forms, legal forms. Those are, or if you have membership from a professional website, those are also deductible. Yes. And any business deductions on top of everything that I mentioned are deductible. If you're unsure, you can ask your accountant or bookkeeper. It's never a shame to ask, because it's better to do it right than to get audited at the end of the year, because again, it's more costly, and the hassle they'll provide you and your family is not fun.
Right. Just a recap. You still have more?
No.
Go for it.
Now our next is a sample of financial statements.
Oh yeah.
Yes.
So before we go there, so the common tax deductions for landlords, as they mentioned, taxes, utilities, your mortgage, repairs, fees, management fees, HOA and professional management fees, and travel event, and what else did I forget? Oh, the legal fees, like with the consultants, the how much you pay your bookkeeper or your accountant when you're filing for taxes. That's pretty much it, huh? Anything else?
Autos, you can do autos to vehicles.
Oh yeah, autos. Your mileage.
Yes,
mileage for your car. Okay.
Yeah.
Got it.
What mileage if you're using your personal car?
Oh, gotcha.
But if the car is under your LLC, or if you have an LLC, then everything on that car is deducted, including the monthly payment, gas, then every single thing. However, if it's under your personal name, you can do the mileage.
Then they do mileage.
Yes. If you're in a personal, you can do either mileage or actual expenses.
Okay.
But I usually tell my clients to use your mileage.
It's faster. It's much better to do mileage.
Yes,
okay.
Usually it's a higher deductions than doing the actual. Yeah.
I've heard this before, but like for some business owners, they at the end of the year they purchase like a big truck or something. It's like if the car is over 10,000 pounds, something like that. What's is there something about like you have to, if they purchase a big truck, it qualifies as a business expense or something like that? It goes over
anything that you bought for the business is actually qualified as.
So it could be a small car or a big car.
Yes.
Okay.
The only reason why they're asking that is how you can depreciate the asset.
Gotcha.
If it's a bigger asset, it's a longer depreciation. Yes.
Okay.
Yes.
Sounds good.
Because for example, the big truck, it could be like a mobile home, right? So instead of 15 years, you could be qualified for 20 years.
Okay.
So now you have longer deductions on your tax return.
So we've touched on the big bookkeeping mistakes, the common tax deductions. And once these deductions are done, how does the bookkeeper what are the things that the bookkeeper provides? What are these reports? So we go with the profit and loss report.
Yes. So the basic report, financial report, is called profit and loss and balance sheet. The profit and loss is pretty much to track your profit, your income, your revenue, and all the expenses. I'm not sure if they can see it, but it will be on the video. So how it broken it down is just the income, total income, and then total expenses, and then profit, and then you see the profit right here.
The net.
Yes, the net profit, and that's what you report to the IRS as a taxable income. Now for the balance sheet. This is the balance sheet. There's 3 sections of balance sheet. There's an asset, liabilities, and equities.
Okay.
So the asset is the actual asset you have, like a house for a rental home, or if you have a car under your LLC, it'll be your car. Now for improvement, you can have the improvement as part of the current asset. And then liabilities would be what you owe. Like for example, you have you improve your house with a cabinet, but you didn't pay the whole thing. You're paying monthly payment. So now it goes to the liabilities because you're still paying for it and you still owe that money.
Got it.
Once it's done, it goes to the asset because no more liability.
Okay.
Now, equity is how much money over time. For example, for the house, you bought at $290. Now it's worth $300,000. The difference is the equity.
Okay.
And everything that you put into the house out of your pocket as an owner is called owner equity.
Okay.
That's what it calls here. Now, if you withdraw money from the business, it also goes on the equity because you're paying tax for it as an owner distribution. It's called owner distribution. So yeah, asset, liabilities, and equity.
Okay.
And this is what you report on your tax return as well. So there is a part on your business tax return that shows balance sheet, and it has to exactly match your balance sheet report, because if you get audited, they're gonna ask for the exact same thing, and it has to match penny to penny.
Okay.
It's the same thing as your profit and loss.
Okay. Has to match.
It has to match, yes.
And then the next is the depreciation calculations.
Yes, which is I did mention that from the previous podcast. So for the purchase of the property, it's pretty simple. It's how much you purchase the house. You actually less the land, because land is not,
Yeah, it's not
you
that
don't
doesn't
depreciate
depreciate,
the
yeah.
land. Yes. And then equals divided by 27.5. Whatever the product, then that's what you get.
Okay.
The answer. So for example, the example I have here is 300,000, the land is 50,000. So now the building value is 250,000. You divide that 27.5, you get 9,000 a month
Okay.
to depreciate.
And depreciation happens in both personal and rental properties, or
Only rental.
Only the
Only
rentals.
investment.
Okay.
Improvement, which is what I mentioned
Right.
earlier, for if you did your backyard, you did your cabinets, you did your roof. So it's
if
a
it's over $5,000, it's
it
better
has
to be
depreciated. Yes,
depreciated.
and that's
Okay.
15 years term.
Okay.
So whatever, say all of the cabinet, you made it fancy, 25,000. You divided by 15,
15.
that's your every month
For the year. Okay.
depreciable. Yeah. And for appliances is 5.
Okay.
Office table, furnitures are also 5.
Okay.
So
5
years.
Okay.
Yes.
Got it.
And it's the same calculation. It's the amount you spent divided by 5 years divided by 12. Then that's what you get, monthly depreciation.
Okay.
Yep.
And I had a question. So let's say someone sells their rental property, and when they were filing taxes on that rental property, they were taking in depreciation. Does that, and then they sold the property. Of course, they're gonna have capital gains tax, right?
Correct.
Unless if they defer it through 1031. But let's say they don't defer it, they don't use 1031, and they're liable for
Capital gain.
yeah. Let's say they've rented it for more than 3 years, right? So they are liable for capital gains. Is there a difference if they have used depreciation on that the previous years, or if they haven't?
Yes. So if you sell a property that you rented, or an investment property, and you've been taking depreciation, you have to add that depreciation back on the income.
Oh, okay. Gotcha.
Yes.
Because
So-
you already took the depreciation.
Because you're using the depreciation is you're using it while you have the business, and then
Right.
or the property. Now that you're selling it, you're adding it back as an income.
Okay.
But you also deduct whatever improvements you made on the house when you first purchased the property. So
Okay.
you're only you're paying tax on the net.
Okay.
So it's the purchase plus, if you have depreciation,
Right.
you plus that on the income, right?
Okay.
So, and then you deduct all the improvements of the house, and then whatever the remaining, that's a taxable income. Now you said if they've been in the house for 2 years and more, it'll be a long term. So which is the interest or the rate is lower. But if it's a short term, 2 years and
Less than 2
below,
years,
then it's a higher interest rate.
Right.
Yeah,
Okay.
rate.
We'll move on to the commonly asked
The
questions.
fun part. Yes.
So we do have a few questions from some of our clients, viewers. For landlords, do I need a property manager? Well,
You can answer that.
If you don't know, Ate Ludi, she is a real estate investor. She owns a lot of rental properties. So she has managed properties herself, and she has hired property managers too. So I'll have her answer that. So landlords, do I need a property manager?
Depends. So if you have the knowledge of managing properties, or you have a clue, you have an idea, you can do it yourself. For example, you're just renting it to a family member, or your sister, your brothers, and all you do is you collect the money, and then you do the repair. You have a good relationship with the tenant. Then yes, I would just do it myself. But if you're opening it to public, the tenant is someone that you do not know, someone that applied, I would hire a property manager, because the property manager will do a background check, will do the due diligence. They'll do the income if it fits with the property that you're renting. And that's very, very important too. It's really important to know who you're renting the house with, in order to save you headache in a long run. Does it cost money? Yes. You're gonna pay them from 8% to 7 to 10%. If you're an Airbnb, 20%.
20 to 30%.
20 to 30%. Yes.
Yeah, midterm rentals about 15%, because the reason why they charge a lot is because the turnover is higher, so there's more work required with the property managers. But not all property managers are the same. Some are pretty good, some are pretty bad. There are many bad, by the way. So just to be careful with that too. And like I said, if you have a property manager, let's say for a long-term rent, they charge 7 to 10% of the rent. Once, if you are managing the property yourself, there are lots of rules and regulations that you need to, for example, if you want just a certain tenant. If you're renting this property out, you're not advertising it, and you have a renter, fine. But once you started advertising that, hey, I'm renting out this house, but I only want this, you can be sued federally, because you are against federal housing regulations. You cannot discriminate for those. So that's why it's much better to do a property manager, especially if you're busy. So I do have property managers on my rental properties, but I also manage a rental property my own, because I know who the tenants are. So what she did say makes perfect sense. Okay. Second commonly asked question is, do I need to keep all my receipts?
Yes.
Okay.
And like I said, if you're not sure of, it's better to have too much to give to your account than less. So what I always suggest my first-time buyers, investors, put a bucket on the side. If you're not sure of the receipt, dump that receipt in that bucket and have your accountant have the headache, because you're paying your accountant to do that job.
Yeah.
So let your accountant work.
Yeah. And when you're doing reconciliation, then you can know.
That's correct. So instead, because when I do the reconciliation, or your accountant do the reconciliation, there's going to be items there that's not sure. So for example, the meal. You spent $5,000 in one meal. Is it for you personally, or this? Then I can go to that bucket and say, okay, it looks like a meal for a conference, or something like that, right?
Yeah. So keep all the receipts.
Yes. Or I can bug you too.
Yeah.
Like,
or do a photo of the receipt better. It's okay.
Photo is okay too.
As long as it has the date and.
Some people, they actually have that scanner.
Yeah.
And they just save it in one folder, and then they send it to me one time.
Okay, gotcha. Like QuickBooks has their own too.
Yes, or Cam Scanner.
Yeah.
Yeah, that's a free app that you can download on your phone or computer.
Okay, awesome. Next question, what accounting method should I use? Accrual or cash basis?
That's a good question. So cash basis is you pay it came out from your bank account, you recognize that expense on that day that it got paid. Accrual is you recognize it when it's used. For example, you have a invoice that you receive for October, but you paid it in September. So the money came out in September, but that expense is actually not until October expense, your October rent or whatever, mortgage. So accrual is, it's going to allow you to use that expense in October, even though the money came out in September.
Okay.
Yes. For cash, whenever it came out, that's when the expense is recognized.
Okay.
And for small businesses, for rental properties, you can use cash because it's the simplest way to do it. But for big businesses, LLCs, corporations, I recommend an accrual basis.
Accrual.
Okay. It's a more work for the accountant, but it's better if you have a bigger company.
Okay. So it depends on what
it depends on your business situation.
Got it. The next question is, can I do bookkeeping myself? Let's say it's still a small business. And can I do the bookkeeping myself? If so, how do I do it? I guess what are the first steps in doing it?
Yes, you can do your bookkeeping yourself. Again, if you just have one rental properties, have a spreadsheet. You write down your month, January to December, put your monthly income, rent, and then expenses. You just write it down. It's easy. You add the income, you minus the expenses, and you have your profit and loss, and you hand that to your accountant.
What are the essential records I should keep?
Receipts, invoices, bank statements, anything that you think where all your income and expenses is stated, where's your record. So everything, those records, you can give it to not to IRS, but to your accountant.
Okay.
And those are the records you should keep.
Okay. And how about the taxes, their income tax returns and all that? How long should they keep it if they've been filing taxes for the past 50 years or so? Like, should they just keep the last 10 years, the last 5 years?
I usually say 7 years.
Okay.
7. If you're good in papers, you can do 10 years. However, if you lose it for some reason, you can always go to the IRS website and you can request a transcript of your either income or your tax return.
Okay.
So they do have, for example, you lost your W-2 or your 1099. You can get a transcript for the income only.
Okay.
Yes.
Got it. For the income only, not the expenses.
No.
Okay.
Yeah. So let me take that back, because if your Social Security is being used on that expense, then yes, it's going to be on the IRS website.
Okay.
For example, your mortgage, your Social Security is on that mortgage. So if you run your transcript on the IRS, it will show that you do have a mortgage statement from this company.
Okay.
With the amount and stuff like that.
Okay. So next, I fixed my backyard. Can I deduct it?
Yes or no?
Yeah.
If it's your personal, no.
No.
If it is your business, yes.
Yes, and depending on the amount that you spent on it,
correct.
It's either an
5,000
asset or.
So if you spent 5,000 below, that will be a repair and maintenance. If you spent 5 and above, 5,000 above, that will be a asset, and then you do a depreciation expense.
Yeah, I bought new appliances. Can I deduct it?
Yes and no.
Yes.
Yeah. Same thing. Same rules. If it's 5 and above, it's a depreciation expense, and if it's 4 and below, it's a repair and maintenance. But if it's your personal home, no, unfortunately, no.
But Nevada Energy provides new appliances if you qualify for it. If your appliances are pretty old, they give you free appliances like freezer, fridge, even washer, dryer. Check their website at Nevada Energy. Yeah. I remodeled the house. Can I deduct it? Can I deduct the expenses for it?
Yes. Okay, so it's a little bit tricky question, because, for example, you bought the house a primary first and then you rented it after. You can do if you did the remodel before the tenant was there, or you were still living in the house as a primary, it's a no.
Okay.
But you can deduct it later when you sell it.
Okay, gotcha.
However, if you remodel the house, the intent to put a tenant there, then yes.
Okay.
Yes, but
let's say you already vacated it, you are living elsewhere, and you want to make it look good to attract more tenants.
Then yes.
So you remodeled it, then yeah, that's okay. That's already. But if it's your primary home, you cannot deduct it.
While you're living there, you fixed it just to make it more comfortable for you. It's a no. However, like I said, you can do that later on when you sell the asset.
Okay.
Yeah, you can deduct the improvements.
Got it. Can I deduct my gas payments and my car payments?
If it's a personal car, and I kind of like mentioned this earlier, if it's a personal car, you can only deduct whether your actual expenses or your mileage.
Yeah.
Now, the challenge, if it's under your name, is because you're using that personally in business. Now, if you're actually using it, you have to kind of separate between the personal and the business use. So I suggest that you do have a log, a mileage log, where, for example, you went to a meeting, you log that. You can use Google; they're pretty good, and you just put the address and then print it and then put it in that bucket. So you have a tracking of your, or if you're a better bookkeeper, you can put it in Excel.
Yeah.
Every day.
QuickBooks also has it.
Yes.
QuickBooks can also track your mileage, and then you could, assuming their app works at the moment that you open it, then you could say, okay, this 2 miles going to Home Depot, or 5 miles showing a client this houses. Those are you could deduct it.
Yes, and please avoid guesstimating, because I have a lot of clients asking, oh, I think I went there and it was 30 miles. Because if you do have the audit, and then they look at, they will ask you to provide documentations. So try not to guesstimate. Or estimate your expenses.
Okay. Last question. Can I deduct my groceries?
No.
Yeah. I mean, if your business is, let's say,
correct,
your business is group home.
Group home,
and you provide food to, that's your business.
Yes.
Your business is what do you call it? Independent living, or assisted living, or home health care, or a restaurants.
Yes.
Then definitely. If it's used for the business, but if you used it personally, then you cannot.
If it's just even like a regular office, you buy food for the office, coffee and stuff like that, you can deduct. But if you go to Costco and you buy steak for your house, no, it's not deductible. And believe it or not, I do get that questions a lot.
Yeah.
Can I deduct even the pets? Can I deduct my I bought something for my pet, and the answer is no, sorry, you can't. Anything with the pets, it's not deductible.
Yeah, that's true.
Yes.
Okay, well, is there anything we've missed?
I think we covered pretty much the basics, the standards.
Yeah.
Yes, but if you have any questions, please feel free to reach out.
Yes.
I'm available in Facebook. I have a website as well, so please.
Yeah, and then like I said, she's a pretty good bookkeeper, and she's very available. You can give her a text or message her on Facebook too, and she answers when she can, which is what we love about her. And again, thank you so much, Ate Ludi Magada, for coming in here.
Thank you again for having me. Thank you for the coffee.
Absolutely. Yeah. And that is our podcast. I'll see you guys the next time.
Thank you.